why you need to know statistics when you work with data? Very simply because everything may seem to be normally distributed, but in reality, data, they are especially like daily log returns of stock market indices, even more if you work with high frequency data on a hourly, 4 hour frequency, minute by minute frequency of volumes of data, you will eventually understand and find that data, they are not, no, I mean, daily log returns of financial assets and high frequency data financial assets are not normally distributed, even if they come up on charts apparently as a Gaussian standard normal distribution. Then when you fit the data and test the machine to know which distribution best fits the data, then you find out that financial assets, they are not normally distributed. The daily log returns of financial assets are not normally distributed, and a good hint you can get is always from the kurtosis, because you can have a mean and a standard deviation which are approximately like normally distributed, but then when you when you investigate further the data and you want to test for the skewness and the kurtosis of the data, which are the third and the fourth moment of the expected unbiased estimator of the data, then you'll find out, for example, that the S&P 500 has a kurtosis of 10.5. And we know from standard knowledge that when the kurtosis parameter is larger than 3, then you have leptokurtotic distribution, which means that the daily log returns of the S&P 500, which are the daily percentage change of the S&P, or the market has rallied 3%, or the market has sold off 2% of 0 point something, all these, let's say, random daily percentage changes, they display a fourth moment of the expected unbiased estimator, which is 10.5. That means that there are heavy fat tails in the distribution of daily returns. That means that the, of course, the financial asset is very, very, very volatile. And so in aggregate, the whole of the data that you take, it's not normally distributed. And then, so before implementing any model, I really suggest to test your data and find which distribution, statistical distribution, yeah, you can do a code here and then normal, log normal, exponential, and all the most utilized statistical distribution, and you will find out that financial asset daily returns are not normally distributed. That's all for me.